The toning down of bearishness on this channel continues after today. After we saw some strength in the equal weighted indices, this was something that we needed to see. We had seen significant strength in the Magnificent Seven stocks, accounting for essentially the entire S&P 500 gain this year, but not so much in the equal weighted stocks. As a matter of fact, if you look at the equal weighted indices, it almost looks like they're in a downtrend. And while I'm not yet convinced that they are ready to outperform in a significant way and essentially catch up to the winners of this year, I do think it's a good sign. And if it does continue, while it might not warrant outright bullishness, buy the dip, go max long, it warrants definitely not being bearish and at least being optimistic somewhat and looking for opportunities in areas that are still beaten up, like the equal weight. I actually bought a bank stock today, believe it or not. That was one of my buys today in this capitulatory short phase that I'm in. So I'm not willing to go super long or anything here yet, and I'll explain why. While the Fed might be done tightening, and that sort of arbitrage that has been prevalent against the people expecting a dovish Fed pivot may no longer be in place, as the Fed says, and the reason why they might be pivoting, the full effects of the tightening are yet to be felt. And whether or not we go into a recession or how bad or how deep it is, that's up for debate and remains to be seen. But the economy is going to slow from here. The Fed is expecting below 1% growth this year. Given how strong GDP was in the last quarter, given where it is so far in this quarter and projected to be, that means they're expecting more significant slowdown in the next 2 quarters of this year. Okay? We're not going off of everything being what's happened in the last day or week in trends and charts. Okay? There's a future out there. So the full effects of the tightening are yet to be felt. And I think the trend of declining earnings, which has occurred, not growing earnings, which had occurred, is going to continue, and it's going to continue to pick up steam. And I think that's why the Fed is doing what it's doing. And the reason why this is important is because normally when this happens, the Fed cuts rates. The Fed eases. And the market has had very much a V-shaped recovery, which is the proper response when the response of the Federal Reserve is bazooka liquidity. That's what we saw during COVID. But that's not so much the response. So I think a lot of these companies that have experienced such a significant run this year, Apple, Microsoft, that are strong businesses, I'm not questioning that aspect of it. What I'm questioning the aspect of is the value. And I was saying this in 2021. It didn't occur immediately. It took some time to play out. But I believe that these stocks are not very attractive investments, despite being incredible businesses. I think they're very crowded, right back up to all-time highs in an environment in which they were experiencing phenomenal growth and significantly lower interest rates. So while I'm not saying go full on short, because it looks like, the Fed might be not doing as much, but possibly might. It looks like the market is able to somewhat deal with it. And I don't trust that. I don't feel good about it, but I just can't go short it anymore. I don't want to go long it either. So that's where I'm standing. What I am starting to poke around at are things that I think have been hated on this year. Energy. I think energy is a very strong place to invest. There's the biggest money in the market refuses to invest. The college endowments, the ESG, the, labor pools, whatever it is, the pools of money that invest in hedge funds tell hedge funds, hey, don't invest there. That's part opportunity for us. The companies aren't happy about that. So what do? They go and prioritize shareholder returns and cash flow, not investing in the long term of their business. So energy stocks have record high free cash flow yields. Quite notable, despite the fall in crude. So I think these are still very good businesses to invest in. They are not investing in capital anymore or anything. They're investing in capital returns. So I also think regional banks, there's a few of them out there that I like. I bought one today. I'm buying a few selective extreme growth companies that I think actually have some prospects long term. I'm buying a few of those stocks, but I'm not going crazy outside of energy. I think energy is probably the best bet in this market. It's been really dogged on so far this year. It's cheap and it prioritizes shareholder returns. It's like literally everything you could possibly want in a stock versus many other stocks that aren't doing the same. So then you got a possible OPEC cut this weekend. That's my take on this market. I do, from a constructive point of view, if you want to call it that, I want to see more than just one day on this weird jobs report that also saw the Fed price in another hike with the full effects of tightening yet to be felt. I want to see more than today of equal weight strength. I want to see actual signs earnings are holding up. So I'm not super convinced yet, but I'm moving in that direction, and I am putting capital to work, not on the short side. I'm pretty much entirely out of the short side. I am entirely out of the short side, pretty much. So now defensive and seeing what happens. Not ready to go all out, but acknowledging that resilience is occurring. That's what's happening. Not super catastrophic. So that's today's video. We'll see what happens. Until next time, peace out.